Good afternoon. We're going to go ahead and get started. My name is Marilyn Serafini. I'm with the Alliance for Health Reform, and I'd like to welcome you all to our briefing this afternoon on the small group market. We are going to talk today about the future of the small group market, both the promises and the challenges, and our discussion today is timely because we're going to be talking about the conversation that's taking place regarding delaying the expansion of the small group market in 2016. So we are fortunate today to have with us a number of really knowledgeable speakers. To my far right, we have Sabrina Corlett with Georgetown University. I'm not going to give you their full bios because you have full bios in your packets. Terry Gardner with Small Business Majority, Katie Mahoney to my left with the U.S. Chamber of Commerce, and Elisa Fox with the Blue Cross Blue Shield Association. I want to let you know that if you would like to live tweet this event with us, the hashtag is smallgroupmarket. You will also see on the screen behind me, you'll see that on the screen behind me. You will also see the Wi-Fi credentials if you would like to use those. So we are going to get started with presentations from our panelists, and when we are finished, we're going to open up for Q&A discussion. You will notice that you have cards in your packets that you can write questions on, and our staff will be circulating. They'll pick up the cards and bring them up, and we can ask them. We also have 2 microphones situated in the middle of the room, so you can ask your questions live if you would prefer. And so we're going to get started now with Sabrina Corlett.
Are you going to do the slides for me? Or thank you. Great. So just before we got started, Marilyn told me that the timer that clocks our time for speaking has malfunctioned and is not going to be used today, which I just want to say that's a very dangerous thing to say to somebody who's both an academic and a lawyer. But I will try. I will try to stay within my allotted time. I was asked to just provide an overview of some of the broader small group market issues, how the Affordable Care Act has tried to affect the small group market, and some future issues, and then we'll undoubtedly get into some more detail with the other panelists. How do I do this? Am I doing this right? This way?
Hold it up a little bit higher. Can we get a little assistance?
All right. Oh, okay, thank you. Thank you. So I'm going to talk about why small group reforms were included in the Affordable Care Act, what they were, some of the implementation challenges that the administration and states have confronted along the way, and then what's next. So the first thing for folks to know is that while the small group market issues have not gotten a ton of attention post-ACA, but leading up to the Affordable Care Act, there were really strong concerns about the future of the small group market and some of the dysfunction that was happening in that market, and many policymakers were really concerned about some of the trends. The biggest trend, of course, is that small business coverage has been on a steady downward trajectory from 44.5% offering coverage in 2002 to 35.2% offering in 2012. And that decline has been ongoing every year, just a little bit more erosion. But other problems before the Affordable Care Act confronting this market, generally high and often volatile premiums year to year, a lack of market leverage. Small employers didn't really have any ability to negotiate with insurance companies over rates or benefits. Higher administrative costs relative to their large group peers. And then many also faced minimum participation or contribution requirements which meant that a certain number of percentage of their employees would have to take up their offer of coverage in order for them to be able to get a policy. And that typically meant that the employer would have to contribute a pretty significant chunk of the premium in order to make it attractive to their employees to enroll. Also, the small group market has had, in general, much less generous coverage than the large group market, and this has been borne out mostly in, for example, in deductibles. Deductibles tend to be much higher in the small group market than they are in the large group. And less choice. Most small employers are not able to offer their employees a choice of insurance companies or often even a choice of plans within an insurance company. Policymakers in developing the Affordable Care Act wanted to try to address some of these pretty significant problems. So the law included a number of insurance market reforms, including new rating rules, such as a ban on health status rating and gender rating, a requirement to cover a minimum scope of essential health benefits, which is the same list that applies to the individual market in the ACA, a ban on pre-existing condition exclusions, a maximum out-of-pocket cost that an enrollee would have to pay in a given year, and an elimination of the minimum participation or contribution requirements if the employer enrolls during a specified open enrollment season. The law also created the SHOP exchanges, or the Small Business Health Options Program, and the idea was to create a marketplace that small employers could go to where they could actually be able to offer their employees a choice of both insurers and plans. And then also the small business tax credits were included in the law. Implementation challenges confronting both the administration and states as the small group market provisions were implemented. Most folks probably remember back in the fall of 2013, there was a lot of consternation about people losing plans. The president had said, if you like your plan, you can keep it. But as a matter of fact, in both the individual and small group market, plans were changing. And so there was a hue and cry about people losing their policies. And the administration in late 2013 implemented what we call the transitional policy or the grandmothering policy. And essentially what they said is you can renew your pre-ACA policy up to 2017. So you can stay on the old plan that had the old benefits and the old protections, but none of the new protections. And anecdotally, I would say that in many states, in many markets, a lot of small businesses did exactly that. In many of your states, a lot of your small businesses are still on those pre-ACA policies. They are not ACA compliant policies. The SHOP exchanges. Some of you may have seen some media around this, but the SHOP exchanges have been, to put it kindly, a little slower to get off the ground than I think perhaps people had anticipated. Just like the individual marketplaces, they did have some IT technical challenges early on, while the FFM shop, I think, was completely offline the first year. This year it is online, so you can enroll online, but there are a few state-based marketplaces that are still not completely online enrollment. And generally speaking, enrollment in the shop exchanges has been fairly low. The small business tax credits have not been taken up to a great degree. And I think Terry will probably talk a little bit more in detail about some of the problems with that provision. It is a fairly limited provision in scope. It's only available to small businesses with fewer than 25 employees and only those with an average salary of under $50,000 a year. And there's some other limits around it, but what you'll often hear from brokers and accountants that work with small businesses is that the trouble of applying for these tax credits is more trouble than the actual tax credits are worth. So looking forward, and there's a lot going on with this market, and I think we'll talk probably in depth today about one particular issue, but I want to highlight a few that are worth the attention of policymakers and regulators. The first is that, as I mentioned, a number of small businesses remain on their pre-ACA policies. And here I'm just talking right now about the 50 and under small group market. However, those policies are not going to last forever. At the latest, they will fall away in 2017, but in many states, they could fall away before that. And so small businesses are, over the next year and a half, going to be transitioning off of the old policies and onto the new ACA-compliant policies. I think one thing you'll hear a lot today is we'll talk about winners and losers. Anytime you have a change in rating rules, in particular, you are going to have winners and losers. And as small businesses come off of these transitional or grandmothered policies, you are going to see some people with premium increases. And some will benefit, but some will not. And so that is just something to be aware of. The big issue that I think is a hot issue right now on the Hill is the change in small group definition. And essentially, there is this provision of the Affordable Care Act that says as of 2016, the state definition of small group market has to be 100 or fewer, 100 employees or fewer. Currently, in every state, it is 2 to 50 employees. And states have had the option to expand their small group market to 100, but none has done that. The change in small group market definition, we'll talk a little bit more in detail about this, but there are a couple of concerns with that. One is the moving groups 51 to 100 into the small group market will subject them to the ACA's market reforms, so the essential health benefit requirement and the community rating requirements. With that, you will have some groups benefit. You'll have groups with perhaps older or sicker workers, groups with predominantly female workers who could get a break on their premiums. On the other hand, you'll have a lot of groups that could see a premium increase. So that is supposed to go into effect under the law January 1, 2016. However, most employers will sort of hear about this when they, at renewal time. So when they sit down with their broker or their insurance company and they find out what's going to happen for the next year, the broker will say, hey, just so you know, there's this change of definition, you're going to be part of the small group market, and this is what's going to happen to your premiums as a result. So sometime over the summer and the fall, people will start to hear about this. That said, the administration, in its formulation of the transitional policy, the grandmothering policy, back in 2014, said that they would make available to states the option to extend for up to 2 years, or until September of 2017, the ability of these mid-sized groups, 51 to 100, to stay part of the large group market. That would be at state option and actually at, ultimately, the option of the insurer to make that available to their customers. At this point in time, we have, and I'm just going to click ahead quickly, about 34 states that have taken up the administration on the option of offering this transitional policy to small businesses. 9 states are not, so they're moving forward with, the orange states here are moving forward with the change in definition, and then there are a handful of states that have not yet issued formal guidance. One of the big issues, and I think we'll get into it a little bit more today, is whether it's for the traditional small group market or for this mid-sized market, whether the changes or the application of the market rules to these employers could incentivize self-funding. And just real quick, self-funding is when the employer funds the employee's benefits out of its own assets or a trust. By doing so, it takes the employer out of the fully insured market and sort of exempts them from all of the market rules and exempts them from any of the Affordable Care Act requirements. For healthy and younger groups, who might face a premium increase as a result of the community rating requirements, self-funding could become much more attractive. And this is mid-sized groups, 51 to 100, are in a better position, frankly, to self-fund many of them than much smaller groups. If the healthy and younger groups leave the traditional small group market, that could lead to adverse selection because you'll have a sicker risk pool in the traditionally insured market. The last thing I'll mention is that there has been some trend. It's hard to measure at this point. It's at this point mostly anecdotal, but that some small employers have found that it is financially advantageous for their employees to go into the non-group market or the individual market and to get premium tax credits on the exchange. It's not totally clear yet how much this is actually displacing small employer plans, but it is a trend to watch. So the last thing I would just say, in my quote here from Mark Twain, is that while there has been ongoing erosion and there are definitely issues that policymakers and regulators need to stay closely on top of, there are going to remain plenty of small employers and mid-sized employers for whom it is very important to them to continue to be able to offer their employees a generous, comprehensive health benefit. They're going to do that because they can get the best talent and they can keep the best talent. So that's going to continue to be very, very important for these businesses. And I think the important thing for policymakers is, how do we stay on top of what's happening in this market, and how do we make it as easy as possible for these employers to do the best thing for their employees? So with that, I'll turn it over. Thank you.
Let's turn now to Terry Gardner, the Small Business Majority.
Good afternoon. Small Business Majority is an advocacy group. We don't get involved in elections. We don't give campaign donations or rate people on the Hill about what they did or didn't do for small business in our point of view. What we do is work on the major problems that kind of face all small businesses in a universal way, such as the cost and availability of health care, access to capital, energy costs, issues with startup, things like that, because we believe that the small businesses are a very important part of our economy and all the employees that work there, and our economy and society will be better if small businesses can start and succeed and grow and provide good jobs and innovation in the economy. So that's our interest in this, and I think Sabrina set the stage, pointing out that this has been a long-term problem, and a lot of the reason the ACA is the way it is because policymakers were trying to help the situation to make it better for small businesses, whether we're talking the over 20 million self-employed entrepreneurs or the 5 million small businesses out there that have 1 to 100 employees in every type of business out there. So all of these provisions we're talking about today were an effort to lower costs, make more options available, and make it easier for small businesses to navigate, especially in the micro business and self-employed category where companies have less resources. The struggle is maybe an understatement in terms of what's gone on with the small business provisions of the Affordable Care Act. In our estimation, there has really been sort of a backseat to the whole shop exchange and the other small business provisions, both at the state level and the federal level in terms of implementation. And there's just been a lot of problems rolling it out. Well, this has consequences to the success of the shop and other provisions because it creates uncertainty and confusion with those millions of small business owners out there, and the insurance brokers they rely on to get advice from as to what they should do. And so the general action of small business owners when this happens with healthcare or anything else is to do nothing. Stick with what you have. Employers don't want to jump into some new benefit that they can't figure out or they're uncertain about what might happen. It could be repealed. Supreme Court might do this. I'm not sure what the state legislature is going to do. This provision might be delayed. All these things they hear out there, just tell them, don't jump into that. They don't want to have to deal with employees coming to them saying, hey, why did you jump into this? It's not working out for me. They want their employees happy. That's why they're paying for insurance for their employees or any other benefit. They want happy, productive employees. They have enough challenges in their day-to-day life. Here we are. One of the purposes here today is to talk about whether we should go forward, as the law says, and expand the definition of small businesses, from 50 to 100, as the law provided on this schedule. And so there's going to be a lot of talk today about delaying this. Well, from our point of view, and we're, I'd say a bit of a voice in the wilderness here, you're going to hear a lot of people, you've already heard a lot of people say, well, we should delay this. There's going to be a lot of terrible things happen. Well, this has been the pattern, and this is undercutting the success of changing the healthcare system as it applies to small business owners and making it more workable for them and their employees. And we fear that delay is more of a do-nothing forever strategy. And we'd like to see and advocate a broader focus, not just on this small issue affecting these group of businesses, but looking at other provisions that have been delayed and making sure they get implemented, the shops all having ability for employees to have choice of plans, which we will think works better. It's been proven in other exchanges. And we would like to see the tax credit, which incentivize more employer coverage, which we all want to see and everybody's concerned about. The CBO gave a very high estimate of the cost of the tax credit at the time the ACA was before Congress, and therefore Congress put all kinds of restrictions trying to get the cost down and still have a tax credit with strong support for it. And we've only spent a tiny fraction of what was estimated. We really didn't need to have all these restrictions that made it very complicated, or you can't have any of your family members, a very broad definition of family members. We don't want owners benefiting somehow out of this tax credit. And then a very low income threshold, which doesn't work in a lot of our states and cities, which have much higher average incomes. So all of these restrictions need to be reviewed and go back to the original intent and the original budget of what people thought was a reasonable incentive for a tax credit. And that will help the small businesses, the employees, and the shop exchange work better. So we think that from a long-term point of view, there are benefits, as was originally envisioned. If we go forward and fully implement the shop exchange and expand the pool of employers that can participate and the number of employees, we will create a larger marketplace. And in the long run, a larger marketplace will have many benefits. One, the exchange itself will have a lower operational cost, which reduces the cost of insurance long run, but there will be more competition because it's a bigger marketplace. And those companies offering policies will want to participate. That is a problem now. We don't have full participation of all insurers in all the shop exchanges, so we need to encourage more companies to participate, make it a robust market. After all, we are a capitalist country. We all claim to be interested in capitalism, except that, it's my company. I, of course, kind of like just my company in the marketplace. That's natural. But, I think society and policymakers need to look more at the benefits of a robust marketplace with more competition. So we do think that there will be benefits to the larger businesses too. They have more experience and they bring in more lives. One of the things that we do need to keep working on in the implementation of the small business provisions is better outreach and communication and making sure the exchanges are working well for the brokers, whether it's the website or the ease of their using it, or what they get. Brokers have to make a living too. And I think this is a different issue than it is with the individual market than the small business market. But if we have more businesses using the exchange, then there'll be more broker involvement. So I think really to wrap up again, we think there should be a much broader focus on making the shop exchange and work, dealing with the basics of, what are our goals? We're trying to get more affordable health care. We're trying to have more options available for employers and employees so they actually can shop, not just be, as economists would say, takers, just take it or leave it, which is what most small businesses face when they go to shop for insurance. And focus on some of the other things that aren't working so well, whether it's small business tax credit, continued to mature these exchanges so they can offer workplace wellness programs. Again, this has been successful in a couple of model exchanges. And again, this would make small businesses more competitive if they could offer wellness programs like large employers do. And thank you.
Thank you, Terry. We'll hear now from Katie Mahoney of the U.S. Chamber of Commerce.
Thank you. Hi. Happy Friday. To start off, I'll give you a little bit of an overview about the Chamber, and you'll see here on the front page of my presentation where we stand on the issue. The Chamber represents employers, businesses of all sizes, small, large, medium, and has a real interest, I think, as we all do, in making sure that healthcare coverage is affordable for employers and for employees. That's a very significant priority of the Chamber, and we look forward to working with the current landscape to improve access to coverage and to services for employees and employers. What I'd like to talk about with regard to this issue is why business cares about this and what it means for business. I think there are some really important connections that would be helpful for you all to understand as we talk about the small group market and as we talk about employers offering healthcare coverage. I'll talk about why the expansion is harmful and what can be done to help. So this is, I'm a visual person, so this is a graphic of sort of what Sabrina explained. And one of the pieces that I think is helpful to think about is also the timeline of the ACA. So when Sabrina explained the different changes that were intended to happen in the individual market and in the small group market in terms of what the new plans were going to be required to provide and what the plans were going to be restricted to do in terms of varying rates in the individual and small group market, many of those new insurance requirements went into effect in 2010 and in 2014. Some of the more significant changes were slated to go into effect in 2014, namely the employer mandate provision, which requires all businesses with 50 or more full-time equivalents to offer healthcare coverage to their full-time employees or potentially pay a penalty. The other big provision that was scheduled to go into effect in 2014 was the opening of the exchanges, both SHOP and the individual exchange. There was some delay in both of those provisions. The employer mandate was delayed for 2014 for all employers and was delayed in 2015 for employers between 50 and 100. We all know that the exchanges had a rather rocky start in terms of healthcare.gov and the website having some problems rolling out. And we'll hear next, I think, a little bit about the challenges that the shop exchanges have had in terms of rolling out and really improving and strengthening the small group market. 2 years after those big provisions, so 2 years after the employer mandate was supposed to go into effect, 2 years after the exchanges were supposed to be up and running, the small group market was going to be expanded. So in 2016, under the ACA, the small group was going to expand from 2 to 50 to 2 to 100. And I think that timeline is important to consider when you think about what this is going to mean for businesses. So those employers 50 to 100 under the original timeline of the ACA would have had a 2-year transition where they would be required to offer coverage to their employees, and they would be doing so in the large group market. Because of the delays which has happened in the employer responsibility requirement and some of the operational challenges with the exchanges, the very first year that businesses 50 to 100 are going to be subject to the employer mandate, they will have to offer coverage in the small group market if this expansion continues. Sabrina mentioned sort of some of the challenges that this expansion will bring for businesses, and one of our concerns as a business advocacy organization is when you look at the employer responsibility requirement, or the so-called employer mandate, that requires all businesses 50 and up to offer health care coverage to their employees. This expansion will really bifurcate that requirement. So instead, folks are aware of the employer mandate and the requirement to offer health care coverage, but I think very few people appreciate that with the expansion of the small group market, you're effectively creating 2 rules of the road for different size businesses. So those businesses 50 to 100, arguably those companies that are going to have the hardest time offering health care coverage to their employees in terms of cost and expense, are going to be required to offer coverage in the small group market if this expansion continues. Those 100 and above would be required to offer coverage and would be providing that coverage in the large group market. So same requirement, same penalty, different markets. And that's something that we believe is not appropriate. I talked a little bit about the delay, the 2-year transition that the law initially intended to have for these smallest of the applicable large employers, those 50 to 100, and we remain very concerned that that 2-year transition period, at the very least, is not afforded to these businesses. There is a provision also in the ACA that allows states to create and innovate, and there's an expectation that potentially in 2017, states would redefine their small group market. If this goes into effect in 2016, you may have kind of a bump where the small group would expand to 100, and then if possible, when states can pursue these waivers in 2017, they would then restrict them to 50. So that's one of the reasons that we would like to see the delay, just to give states a little bit more flexibility. And Terry had it right. You know, we would like to see this provision delayed and ultimately halted. We think that that is going to help businesses and help employees in terms of improving their access to healthcare services and to coverage. I would urge you to talk to your congressmen and senators, talk to the administration. We've weighed in with 19 other trade associations that represent businesses of all sizes with the administration, urging them to delay the expansion to afford businesses at least that 2-year transition that the law intended. We are also working with members of Congress to restore the small group market moving forward to 50 and under, and give that ability back to the states to increase that size if they'd like to. There are 2 bills, bipartisan, bicameral bills, H.R. 1624, which is co-sponsored by Guthrie, Cardenas, and Sinema, and that bill enjoys 84 co-sponsors, 16 Democrats. The Senate bill, S. 1099, which we think is an omen, is co-sponsored by Scott and Shaheen and has 5 co-sponsors, including 3 Democrats. So we are very hopeful that this effort will continue to gain traction, and I hope that you will speak to your bosses or or your representatives on this issue. And with that, I'll conclude.
Great, thank you, Katie. Before we turn to Elisa, I want to give you two reminders. One is that if you are live tweeting, and which we encourage you to do so, the hashtag for today's event is hashtag small group market. You may also submit a question that way. That's another vehicle to do that. And also after Elisa finishes with her remarks, we will open up for Q&A, so get your best questions ready. We have 2 microphones in the audience. You also have a card in your packet on which you can write questions, and our staff will pick them up. So without delay, I'll turn it over to Elisa with the Blue Cross Blue Shield Association.
Thank you, Marilyn. Yes, the Blue Cross Blue Shield Association represents the 36 Blue Cross Blue Shield plans across the country. Blue plans offer coverage both on the individual, small group, and large group coverage, both insured as well as self-funded options in every zip code in this country. So we care deeply about making sure that coverage is as affordable as possible. And what I planned on saying was said very eloquently by everyone in one way or another. So I'm just going to hit the high points. I think it's really important to note that when Congress has acted on insurance reform issues in the past, they've really looked to the states for their actual experience. And they've done that for, setting the parameters of rating reforms, et cetera. So they had actual experience to know what would happen in a state before they expanded it nationwide. In this instance, that just didn't happen. Before the Affordable Care Act, no state went above 50, as you heard before. And the expansion in the ACA, which is set to take effect this January, to go to 100, was based on the perception that the bigger the pool, the lower the price. And it makes sense, that you have a bigger pool, the price comes down. Unfortunately, the insurance world doesn't act that way, and all experts in the insurance industry will tell you it doesn't, and I'll talk about why that isn't the case. Because whenever anybody has an option to get a lower price in another way, people will make smart financial decisions for themselves, and that's the problem with the expansion of 50 to 100, which will end up meaning everybody pays more, and we don't want to see that happen. So I will say that when we look at this expansion, very, very just simply, what it means is that all the rules that now apply to the small group market, and which haven't applied because of these transition rules, will now apply to the 50 and 100 for the first time. And that's new benefits, and it's all the new rating rules, which means average rating. When you talk about community rating, it's really an average rating. So what's the impact on mid-size employers? First of all, it's important to know that there are 8 million people, including employees and their dependents, that would be affected in the mid-size market. That's how many people there are today. Oliver Wyman actuarial firm has estimated that 64% of these people would see a rate increase averaging 18%. That's immediately. That's what, when it's fully implemented, people would get an 18% rate increase. That does not include trend, and it doesn't even include the new benefit requirements. It's just because of the rating rules. 23% of these people would see a rate increase of 20% or more. Now that's the impact on the mid-size employers. Importantly, the mid-size employers would no longer be able to keep what they have. They would have to fully comply with the new ACA benefit rules, which means they would have to change plans. The premium impact will worsen over time. And this is, again, going the bigger the pool, the better the price, and let's talk about that for a second. Mid-size employers, once they get presented with an average of an 18% rate increase, they're going to want to go shopping. And there's lots of options in the marketplace today for mid-size employers, the 50 to 100, to self-fund their benefits, as Sabrina talked about. So that means if you're healthy, relatively healthy, and younger groups, you're going to have a strong incentive to self-insure. And people will be advising you that that's a better way to avoid this big rate increase. They'll also tell you that if you get sick or someone in your group gets sick, you could immediately go back to the insured group, the small end of the market, the 2 to 50, and you'll get pooled into that pool if you're sick. So basically what you have is a system where young and healthy mid-sized employers opt out, and they're in the self-funded pool, and the relatively older and sicker people who need more medical claims will go into the small group pool. So, and they can ping pong back and forth really every month because there's no requirements like 1 year open enrollment or anything like that. You can change every month if you choose. So what does that mean for the small employers? That means immediately the small employers' rates are going to go up probably around anywhere from 5 to 7% because it's not just a bigger pool, it's the people that are coming in have a lot of medical costs, and that's going to make the small employers' premiums even more expensive. And I think it's really important. I know that Marilyn's included a lot of these materials in your packet. It's not just our perspective on this. The National Association of Insurance Commissioners has said this, the American Academy of Actuaries, the broker community, and all the insurers and every actuary will tell you the same thing. So our recommendation is not to delay this. We would like to see it permanently allow states to determine the size of the small group market. And again, we are very supportive of the two bills that Katie just talked about. They have broad support. The NAIC has supported this bill, as have a broad range of diverse groups. And timing is really critical. These rules are set to take effect in January, and we believe that it's just critical to keep the premiums for all small employers, as affordable as possible. Thank you.
So let's turn now to the question and answer portion of our discussion. Again, we have 2 microphones in the room. We also have cards in our packets, and you may also tweet questions to #smallgroupmarket. I'm wondering, while people are getting situated with their questions, if we can follow up on discussion about what is happening on Capitol Hill and with the administration on this. Katie, you mentioned a couple of pieces of legislation. If our panelists could talk a little bit about the timing of what may happen, what could potentially happen, what is the state of play with legislation, and if something was going to happen, when would it need to happen, and how would that affect rates?
I think I'll jump in here if that's okay, Marilyn.
Please.
We see that these 2 bills are getting more and more broad bipartisan support, and we very much would like to see it enacted as soon as possible. We think there's so much support, and there will be increasing support, that it's very possible to get this bill enacted, possibly even by itself, as soon as possible. July would be terrific to do that. So it is the best way to keep premiums affordable.
And just to kind of give some color to that, we had 10 co-sponsors add in one day yesterday. So it's really getting some significant attention. And I know that I'm making visits, colleagues of mine are making visits. It's a huge concern to the business community, and we will continue to come and visit folks up on the Hill and hope to drive up that co-sponsor list.
The only thing I would add, I'm not familiar with the legislation, the sort of status of the legislation, but the only point I would make is that while it may seem, sitting here in June, that January 1 is very, very far away, for insurance companies, it's not. And the uncertainty around this definition, the status of this definition is not helpful. So I would say that whether it's a state that needs to make a decision about the grandmothering or the administration or folks here on the Hill, delay doesn't benefit anybody.
Okay, so we have a question about self-insurance. People keep talking about self-insuring. Can you discuss how easy or hard it is for a business to self-insure and how this fits into this discussion?
It's pretty easy for especially larger groups to self-insure. There's lots of companies out there that do that today. There's some very strong incentives to do that already. If you're self-insure, you're out from the essential health benefits, for example. You're also out from under the health insurance tax that adds about 3% to the cost of small businesses' premiums. And you're also out from under premium taxes that states might impose. So there's some incentive already. You haven't seen it huge in this marketplace, but the concern expanding to 50 to 100 and you give someone a big rate increase, there'll be brokers and insurers who will make sure people understand the option to get a lower price by avoiding all of the community rating rules, the benefit rules, the health insurance tax, as well as these other rules. So it's a very significant incentive.
And just to be clear, I think I know the U.S. Chamber and I think others on the panel support the ability for businesses to self-insure and certainly don't see that as a problem. It's, this issue, as we all know, is very complicated, and so there are lots of ways that, pushing on one side of the balloon impacts the other. That's not to necessarily implicate in any way that there should be restrictions placed on the ability to self-insure.
I would say that if you've got a healthy young group of employees, it's really easy to self-fund in most states, even for very small groups. However, if you don't, and insurers will tell you this, it's not easy to self-fund. So it really just depends on what kind of group you've got, I think, because if you've got a sick group, it's not easy to get what's called a stop-loss or reinsurance policy to help cover those potentially catastrophic claims.
And the other part of this is, that goes beyond whether it's easy to do or not, is whether it is wise and good business to do. I think traditionally most people that have looked at this, and I know I have been started and owned a company that grew and eventually self-funded itself, so I personally went through this process as a CEO in 2 different companies. And traditionally people said you need about 200 employees, to have a large enough group, because self-funding for a 10-person employee group, even if they're all young and healthy, stuff happens. So one, large claim in a small group of 10 for a small company, it doesn't work out too well because you've got such a small premium base there. So I think this has been a problem for quite some years and a growing problem that there are, in my estimation, some newer, smaller players out there marketing products to businesses that are too small to have self-funded plans, and then problems occur down the track. And this is a pretty unregulated area by both states and feds, and everybody's just kind of not dealt with it. So we believe, like everybody else has said, that this is a good idea if responsibly and wisely used with companies that are large enough, have enough resources, and are sophisticated enough to do it. And there are responsible insurers putting out good products and giving good advice to companies, but there's some that are not. And so this is a bit of a time bomb. Even without this delay or not delay issue, it really needs to be dealt with.
Terry, that was really well said, and I would just say real quickly, one thing I really want to emphasize is this is an area for which there's almost no regulatory oversight. States are not watching what's going on here, and the feds for sure are not. So it is a potential time bomb, particularly if you get a small group that shouldn't be self-funding that does, and it really could cause significant harm.
So we have a question to follow on. What are the ways to prevent groups from moving to self-funded? thus leaving the small group market with high-risk members?
Our recommendation is enact 1099 and 1684 because expanding the 50 to 100, once you get that 18% average increase, strong incentive to self-insure. So, enact that bill, and it will be reduce that incentive in a major significant way.
Others might be able to speak to this, but I know when I inquired before, it didn't even seem like not only nobody's regulating, but there isn't even very good data on what's going on, and that's a first problem. How can we deal with a situation that is anecdotal and we just get reports? So we do need better data to see whether, what we hear out there in different states and different markets, if there really is change going on, and what size of companies and where is this happening and what, kind of stop loss are they doing. And then part of the data we need also is what was referred to is the companies that have a bad experience, then they go back as soon as things aren't going well into the marketplace, and that's obviously bad for everybody else in that pool. Today, whether it's, in the exchange or not in the exchange, that's not, a good process. So that's a first step, is to get better information so that we could actually then advise state and federal regulators on how to deal with the problem.
Can you talk more about the benefits of delay versus permanently changing the law? Also, can you discuss these options with respect to 1332 waivers? And perhaps it's worth taking a step back to talk about why we are talking about this in the first place. Why are we talking about expanding in the first place? What is the thinking behind that?
I think Elisa said earlier that when the provision was originally included in the Affordable Care Act, I think there was this conception that expanding to 100 would lead to a larger risk pool and therefore lower rates for everybody, and particularly for the traditional small group market. But I think Elise is absolutely correct that when you do have sort of escape route options for people who might get hit with premium increases as a result of this change, such as self-funding, it sort of it gets in the way of the beneficial effect of that large risk pool, and could ultimately backfire if too many healthy groups leave the traditionally regulated market.
I think in terms of delay versus halt, the delay, I think, was something that we thought the administration had the authority to do, and that it was within their purview, given sort of the effect of the timeline as originally contemplated and sort of where we are now. I think time has sort of moved beyond the possibility where delay can really be helpful. I think we'd like to see a more permanent solution, but the thought was, to try to provide relief as quickly as possible, and sometimes working through the administration might have been an easier lift, and we really thought that they had the authority and that they might have an interest in delaying this provision based on kind of what our concerns were. And I think now the focus really is on halting on a permanent basis.
Okay, we have a question at the microphone. If you would kindly identify yourself.
Hi, my name's Katie Allen. I work for Congressman Black. This is shifting gears a bit, but I was wondering if you could address, assuming the law stays the way it is right now, some of the interactions you're talking about happening with the new definition with the Cadillac tax, and how the Cadillac tax might differ for smaller employees, the effects of it versus larger employers, and if some of the problems with the design of the Cadillac tax, if that is as big of a priority for smaller employers as it seems to be for larger ones.
I'll jump in. So we call it the excise tax because it's not on Cadillacs, it's on Chevys and Pintos and pretty much anything. But just to kind of level set, the 40% excise tax is a tax on benefits on group health plans that exceed a certain dollar threshold, and that provision kicks in 2018, and it's another one of our huge priorities at the U.S. Chamber. We have some very serious concerns about the excise tax and its effect on all businesses, and I think it's safe to say that if employers are put in the small group market and having to offer health care coverage, and our fear is that premiums will increase for those small businesses, that they would be more significantly hurt by the expansion in lieu of the excise tax. But we're looking to repeal that too.
Okay, could the ping-ponging problem be solved by limiting enrollment to an annual defined period instead of allowing people to change enrollment every month?
One suggestion actually I might make, some states, I know Colorado and maybe a few others, have tried to mitigate the problem by imposing a premium surcharge on groups leaving self-funding. So if you've been in the self-funded market because that was advantageous to you, but then you have your group gets sicker or older and you want to move back to the traditionally regulated market, a premium surcharge is imposed on you. So the idea is to create a real disincentive for exactly that kind of ping-ponging and the adverse selection that can result.
Perhaps there might be an opportunity to have another panel on self-insuring. It sounds like there's a lot of interest in this issue, and I'd love to have an expert up here, and I'm unfortunately not the right one to talk about the merits of self-insuring and the protections that do exist, because we believe that that's very important.
And we don't think an annual open enrollment will make much difference. The 18% figure that Oliver Wyman came up with, that's day one. And if you even move, it doesn't even take into account, you could change every month. It's really significant right away. And if you do it, let's say, once a year, that's still going to have a major significant issue. So we don't think it helps.
Yeah, and from a small business owner standpoint and the way the systems work with the heavy reliance on brokers by small business owners, I think that would be a really bad idea on a practical basis to have an annual enrollment date. It just would be very inflexible and kind of focus all of this effort into one particular calendar date, just kind of like tax filing date and other dates that cause a big stampede and don't have much relevance to small businesses which have a lack of administrative resources and expertise trying to deal with all the issues they have to deal with in an annual cycle.
Okay, we have a question at the mic.
Hi, my name is Deneen Grooms. I'm with the American Speech Language Hearing Association. So I was wondering maybe if you could talk a little bit about the current size, I guess 2 to 50. Do we know how many small employers have encouraged their employees to go into the shop? And also, do we have any idea, I guess, how attractive the healthcare tax credits are for these employers? Is it just easier for them to say, I'm not going to offer this, just go on the individual exchange market and try to get insurance?
Well, let me start, and then I'll flip it over to other people to talk about maybe the small business tax credit, which we are very supportive of, but it hasn't really achieved what people wanted to do. When you really look at the shop is enrolled very, very small employers, and I'm just looking at some numbers. Of the state-based exchanges, all of them, with maybe one exception, the average size of the employer is under 10. So it's really the real small employers that are going into the shop. And I think the other thing to note about the shop is the premiums. The law requires the premiums to be exactly the same inside and outside the shop. So when a Blue Cross Blue Shield plan puts a product on the shop, you can buy the same exact product off the exchange for the exact same price. And the shop enrollment has been low, principally because we understand that it's been difficult to access, and people don't necessarily see the benefits. The premiums are the same. You do get a benefit of picking some employee choice, so employees of the firm can pick maybe a couple of different options. It varies by state, but there are also private exchanges, especially when you look at the mid-size employers. A lot of those mid-size employers have private exchanges that do that too.
The one reason, distinguishing the individual tax credit from the small business tax credit, which the employer receives, they have to go through the shop exchange to get that. But it hasn't, even before the shop exchanges, it was difficult for small businesses because of all the restrictions about they couldn't if they had family members, and then looking at their average income was another restriction, and and it only applied if you're under 25, and then there was a very steep decline to get to 25. So even if you had 20, you might be down to your credit was so low with all these other restrictions. So that's why there's been very low uptake. And again, that eventually became one more reason not to use the shop exchange, as opposed to if the credit had been, if we'd actually spent what CBO projected, there would be a lot more participation in shop exchanges because it would have been a worthwhile tax credit for small employers, and they would have gone to the shop exchange to get that. But so that incentive doesn't work. And as was said, if it's the same policy and price inside and outside, and the shop exchange doesn't promote and allow employees to, with that one employer, to pick different plans, well, there's no advantage. Again, you fall back to, let's just stick with the world we know, because there isn't really any differentiation, which is what we need in a free marketplace. We're not going to switch from one car or one phone to another one if it's a copycat. So the shop exchanges have always been based on the fact that they're not going to work unless they're actually different. And so everything you do to make the shop exchange and the outside market identical is there. And I think these private exchanges are growing because they're doing something different. They're offering something different, and that's why people are migrating. And I say good for them. That's the way the marketplace works. They're coming in offering something different.
And if you don't mind, Jerry, just clarify, the ACA is very clear on the point that it's required that insurers charge the same amount inside and out. And I don't know if you were suggesting a change to the ACA or a delay or something here.
No, I wasn't suggesting changing that. I know there's very good actuarial reasons and reasons for that particular provision, and we agree that has to be. But it's not the insurance industry's obligation, but the people running exchanges' obligation to implement other strategies so that they are a worthwhile place for small business owners and brokers to go.
Is there a question?
My name is Jacqueline from Senator Kuhn's office. Since we've been talking so much about the small business tax credit, I did just want to flag that Senator Kuhn's has a bill to actually expand and simplify the small business tax credit. It's S379. Would be happy to answer any questions about it, but it does address the average wage threshold and increases the number of employees that a small business can have up to 50, and simplifies a lot of those restrictions that limit the tax credit availability.
Thank you.
I hope CBO is giving you a more conscientious, accurate scoring on that based on the actual experience.
One thing I think that's helpful to think about is, while we haven't really taken a position on the Kuhn's bill, and it's great, any efforts to help businesses offer healthcare coverage to their employees, we think is a good thing. But I think it's also helpful and important to think of, well, what can you do to reduce the cost of healthcare. So to the extent that you can help employers pay for it is a good thing, but that requires money, and reducing or halting this required mandated expansion might be a way to reduce the cost associated with that coverage too. So sort of the opposite side of the same problem.
I would just add that we, we're not CBO, but we've done our own little math, and we think 1099 would actually reduce costs. So it would be scored as a saver, although CBO hasn't officially reviewed it. We think there's a good case to make that it actually reduces the federal budget.
Okay, we have a questioner who's talking about the rating protections under the ACA, including the ban on gender rating, and wants to know, would there be a way to expand these rating protections to businesses with 50 to 99 employees if they do not join the small group market?
Well, let me comment on how the rates for 50 to 100 are now determined. I go first, it's really important to know that no employer is permitted to charge different rates to their employees based upon their health status, their age, or their sex. So that just doesn't happen. When an employer, what happens, what insurers do today is they take the pool of 50 to 100 and they pool it with employers up to 500 generally. So they're in a broader pool. There'll be some percentage that's based upon the group's individual experience, but the vast majority of the rate is pooled with all groups that are in the insured market up to 500. So I think clearly, nobody is being charged differently if they're a man or a woman in that segment.
Yeah, I think this is just an area where we need a lot more information about the 51 to 100 market. We don't have a lot of data about the kind of benefit packages that are being offered to employees in this group. We don't have a lot of information about how many groups get a gender rating surcharge because they are have predominantly female employees. We don't know how many groups are age rated. We don't know how many groups are having problems because of health status, and we just don't, policymakers just don't have the data that I think is really important to understand what the impacts would be of this change in definition. So I think we all I think there's consensus here, there might be winners and losers under this change. So if you have an employee group of mostly women, you might actually benefit by this definition change. But, I think for policymakers, the difficulty is, do the benefits that accrue to a group like that or to a group with a lot of 50-plus-year-old people, do they outweigh the potential premium increases that a younger, healthier group might face? And that's often a difficult call.
It has happened. We have a King v. Burwell question. How would a Supreme Court ruling in favor of King affect the SHOP and other ACA provisions affecting small employers, if at all?
We talked a little bit about this before the panel. So the first thing is that there really is no impact to small group insurance per se. The King decision really will have its primary impact around the employer mandate, and then, of course, the non-group market reforms. However, one thing that a couple of us before the panel were talking about that I think is important for folks to understand is that there's about, I think I had it on a slide, there's about 34% of small businesses currently that are offering coverage to their workers, Well, that means that there's about 66%, right? Is that right? Am I getting that right? 66% who are not offering coverage to their workers. That means that, the question is, where are those workers currently getting coverage if they're not getting it through their small employer? And for many of them, they may be getting it through the non-group marketplace, and they may be getting it with premium tax credits. So in many ways, the King decision could be really devastating for a lot of small businesses because their employees are losing that critically important health coverage.
Yeah, I think one of the effects in the small business world would be to startup and young growing companies. They're, the greatest proportion of that 66% of small businesses that aren't offering coverage because they're just started up. They don't have very robust packages. And if you look at the data and it's pretty consistent in all states, the average wage or annual compensation, every way you want to break out the data of small businesses, 1 to 10 employees, is considerably lower than, say, 100 to 500. It just goes down the scale. Now as those companies grow up, they pay more, is what the data shows, and they provide more benefits. There's a very high correlation to number of years in business and offering health benefits to your employees. So what we have right now that's changed with the ACA is a lot of startup companies and young companies, 1, 2, 3 years of age. Their employees are going to the individual exchange and getting health insurance, and they may be getting credits for that. So this would be, a general hit to that segment of the economy, to the startup world and the employees that work at startups. And it may impact them. A lot of times, in the startup world, the entrepreneur that's starting the company just kind of like, it's too complicated. I'm just paying you money. I don't have a retirement, I don't have health insurance, this is what I can pay you, and you deal with it. Because they're just scrambling, trying to keep their head above water. That's a typical model, that happens, and then they start to feel the pressure. So this would be definitely a negative benefit, impact to this sector.
Okay, I'd like to turn back to the SHOP exchange. And as we know, enrollment has been relatively low at this point. Is it fair to compare enrollment in the SHOP with enrollment in the individual marketplace? Do we need more time to see if the SHOP exchange is going to work well? Is it too early?
Well, I think anybody that looked at before the ACA at SHOP exchange versus individual exchange came to the conclusion that, wow, it's a lot more complicated to do a SHOP exchange than an individual exchange in the first place. So then we have compounded that by, a large amount of the effort, and I heard people say why they did it, so I'm not judging it, but I think the fact of life is that more effort, both at the federal level and the state individuals, great proportion of the effort was put into standing up the individual exchange, as they say, and less effort into it. Well, that's kind of, you put less effort into the more complicated one, guess what? And then, of course, we've listed here many of the delays that have undermined, in our opinion, the success of a robust exchange, and we do have sort of a slow, fitful rollout. So I think we haven't seen the full potential of these exchanges, and I think it's only going to come about to have the full potential realized by people putting that are operating the exchange and policymakers and stakeholders putting more effort into figuring out, how do you make the exchange, the SHOP exchanges viable and work better.
And I would just add that when you look at the individual exchange, almost 90% of the people in the exchange are people receiving subsidies. That's why people go to the exchange. If you're not eligible for subsidies, most people are continuing to go directly to their individual insurers and not go through the exchange. And when you look at SHOP, SHOP's attractive to those people that want the subsidy. And as we've heard, the subsidy, has some issues with it. So that's really what's been attracting people to these exchanges.
Okay, which actually leads in perfectly to the next question, which is and this is a more general question, but what would it take from a policy and operations standpoint to make this more palatable, one, for insurers, and two, for medium-sized employers? I would also add brokers into the mix. What are the challenges for brokers, and how do we encourage broader participation from the brokers?
And this is specific to the shop. How do we make
Yes.
the shop more palatable? Well, as it seems like it was a century ago, but as I remember the debate when the shop provisions of the Affordable Care Act were first being developed, there were a couple of issues, and it wasn't just the premium tax credits. I think the shop was trying to address a couple of different problems in the small group market. One was the lack of buying power that small employers had vis-a-vis insurance companies. Small employers were saying, look, it's a take it or leave it offer from the insurance company. We have no leverage to negotiate a better rate or a better benefit package. It's just, that's it. And so that was one thing the shop was supposed to be able to offer to employers, was the ability to really shop between issuers and between among benefit packages in a much more kind of apples to apples kind of a way. The second thing that people were hearing from small businesses at the time was that I can only offer one plan to my employees. And it sort of had to be a one-size-fits-all option. So, whether you were a 63-year-old man or a 23-year-old woman, there was just one plan that we could offer to their employees, and they wanted employee choice. They wanted to be able to offer their employees choice. So those were the two things, in addition to the tax credits, I think that policymakers were trying to deliver to small businesses. The truth is that those things have been harder to deliver than I think anybody anticipated. And frankly, I just went through this in my own family with my husband starting a small business when he went to a broker in Virginia and said, we want to buy health insurance for this small business. The broker didn't say a boo about a shop exchange. It was literally not even discussed. So I think there is a big problem out there in terms of brokers not really seeing the advantages for their clients with the shop and not marketing it. And the fact that the employee choice has been delayed, as Terry pointed out, and the fact that at this point in time there's not a lot of issuers that are participating in many shops. So I do think the folks running the shop exchange need to think about how they can add value, how they can get the word out among brokers. And, for brokers, I think ultimately it's about how they're compensated. And if they're not being compensated for the time it takes to enroll somebody in the shop, they're not going to steer them that way.
Okay, so as we near the end of our time, I'd like to ask everybody, before we get to our last question, to please, in your folder, look for the blue sheet. It's an evaluation sheet, and that helps us to do a better job in putting these briefings together for you. So if you could kindly fill that out, we would appreciate it. So in our remaining few minutes, I would like to ask each of our speakers what is their biggest priority. If they could see one thing or a couple of things happen, if they could wave their magic wand, what would you want to see happen to make improvements to the small group market, or make this just see improvements? What do you want to see happen? What is your biggest priority in this area? Sabrina? Elisa?
I would say, first of all, in addition to enacting the bills we talked about, we are continuing to work to transform the delivery system. We think that is the critical way of achieving higher quality, lower costs. We have a four-part strategy that we're working on in every community across the country. We're seeing some terrific success. We're very excited about it. Just last week, we announced that in 2013, where we have hard data, we saved $1 billion nationwide through these initiatives. And it's the kind of thing that it's not a one-time deal. It's a continuing iterative process where we have to look at what we're doing and build upon it, share best practices, and improve what we're doing. But we need to change our delivery system to reward outcomes and quality, and that's the way we think we can really get significant savings and better value to not only employers but to individuals. But we need to avoid this problem that's going to start next year too.
I think we have kind of one overarching goal, and to accomplish that would require several different things. But I think the overarching goal of the U.S. Chamber is to improve flexibility so that employers can offer affordable access to healthcare coverage and services at an appropriate way, in an appropriate way for their companies. I think in order to do that, we would like to see changes made and repeal of the excise tax. We would like to see the employer mandate repealed. We would like to see 1099 and HR 1624 enacted. So, and also some efforts to deal with some of these taxes that are driving up the cost of coverage. So it's a easier articulated overarching theme. How you get there requires quite a bit of work.
I'd start by saying, for those that want to delay the expansion of the market, after that delay happens, you will have no change. It just preserves the status quo. So I would call that a hollow victory from a small business point of view, because nothing will have gotten better or changed. And unfortunately, I don't think there is a silver bullet in terms of a single silver bullet how to make the shop exchange and the small business market. I think we've talked about several Band-Aids, reform, simplify, expand the tax credit, fully implement employee choice in shop exchanges. And I think exchanges, there are viable models with other exchanges that have developed workplace wellness benefits that work in tandem with the good programs that like Blue Cross and other people are offering to small businesses, not duplicating those, but supplementing things that don't make sense for them to offer, and regulate the self-funded market so it doesn't get out of control under any scenario, delay or no delay. And then both the federal and the state exchanges, not everyone, but most of them sort of need to restart their relationship with brokers and get off on the right foot and make sure that the exchange functions and works well for the brokers as well as small business owners and employees, so that they're engaged and will mention it to a new client.
Well, thank you for giving me a moment to think. But so as I think about the biggest pain point for a small business owner when it comes to buying health insurance, it's price, right? Like that's what's hurting them right now. And it's been hurting them for a long, long time, long before the ACA was ever passed. So one of the early promises of the exchanges that I think has sort of fallen by the wayside in the wake of just all the startup headaches and glitches is, could you use the exchange to aggregate the buying or market power of these individuals and small groups that currently really have none, and use the exchange to not necessarily negotiate price, because as Elisa said, it has to be the same inside and outside, but to almost act like a large purchaser in the marketplace, similar to a Medicaid agency or the Medicare program or a large IBM or CalPERS, and say, you know what, we need to see whether it's ACOs or pay for performance or sort of whatever folks think, better outcomes, whatever folks think are the ways to address the crux of the price problem, which is the fact that we have the most expensive healthcare system in the world with poor results to show for it. But to sort of aggregate the power of those small business purchasers so that they can all sort of say, we want a better value out of the premium we're paying. And that means better care, and that means, not paying outrageous prices for hip surgeries at one hospital and $10,000 less at the hospital down the street. So if I could say one thing that might help, and this would be a very long-term thing, could the exchange act in that way to really be an agent acting for small business customers in the marketplace and be their voice for them?
Great, thank you. I'd like to thank the Blue Cross Blue Shield Association for the support of this briefing, and I would like to thank you all for being here, and I'd like to thank our panelists. Please help me thank our panelists for their knowledge, sharing their knowledge and input.